Welcome back, my beautiful friends. You're listening to A Moment of Zen right here on 710 WOR, the voice of New York, iHeartRadio. I'm your host, Zen Sands. Up next in our Business and Buzz segment, brought to you by Revere Securities, we're featuring our regular contributor, Kyle Wool, non-executive chairman at Revere Securities, along with Thomas Hayes, founder of Great Hill Capital and hedgefundtips.com. He's constantly featured on Fox Business TV, CNBC, Yahoo Finance, Wall Street Journal. That's just to name a few. Now, here's a fun fact. Prior to starting Great Hill Capital, Tom worked with a hedge fund called Cornwall Capital, one of the firms featured in the Michael Lewis book and movie, The Big Short. Today, we're chatting money market versus capital market. What's the difference and why you should care? Thomas will also give us his overall take on the markets and his end of the year outlook. The money market and the capital market are not single institutions, but two broad components of the global financial system. The money market is the trade in short term debt. It's a constant flow of cash between governments, corporations, banks, and financial institutions borrowing and lending for a term as short as overnight, but no longer than a year. The capital market encompasses the trade in both stocks and bonds. These are long term assets bought by financial institutions, professional brokers, and individual investors. Together, the money market and the capital market comprise a large portion of what is known as the financial market. And understanding the difference plays a role in understanding the market as a whole. Holding assets that are part of the money market versus the capital market could influence your investment outcomes and degree of risk exposure. And here to give us insight and edutainment are my experts at hand, Kyle Wool and Thomas Hayes. Welcome to the show, gentlemen.
Thanks for having me, Zen.
Thank you.
Kyle, let's start with you. So how do capital markets and money markets differ, and why is it important to follow both?
Well, I think they're two completely different sectors of the market, right? Your money market's based on the Fed funds rate. So as interest rates go down, you'll get less return in the money market. And recently, as you probably noticed in the average American or corporation in their cash account, interest rates have been going up. You're seeing a 30-year bond going up. So you're probably starting to see nice interest payments inside of your Chase account or your Bank of America account or wherever you keep your money. So with money market rates up, you get a little bit better return on your money. You're going to get better return on your certificates of deposit. You get better return on your one-year treasuries. Now, the capital markets is a completely different topic. The capital markets is, for sake of the S&P 500, the Russell 2000, it's your large cap index, your small cap index, your international indexes, and they can move around quite a bit. As you've probably seen at one time this year, the Dow Jones Industrial was down more than 20%. The transportations were down more than 30%. Most people don't pay attention to when the market goes up. They talk about it more when it goes down. But now the Dow's down almost less than 6% with the markets the way they are right now. And they move around quite a bit. And you have to understand, if you're going to invest in the capital markets, there will be volatility. And that's risk to reward.
I like the way you broke that down. So to my understanding, the money market is a good place to park cash for a short period of time so that businesses and governments that need cash to operate can get it quickly at a reasonable cost. And so that businesses that have more cash than they need can put it to use. While what you're saying, Kyle, that the capital market is the segment of the financial market that's reserved for trading of really what we call these long-term debt instruments. So thank you for clarifying that. Thomas, in terms of the difference between capital and money market investments, it usually boils down to three things: liquidity, duration, and risk. While the money market is focused on the short term, the capital market is a longer term play. Capital markets can deliver higher returns, though investors may assume greater risk, to Kyle's point. Why is understanding the capital market important, and is taking those risks worth it in a volatile economy like now?
Yeah, well, basically, when you talk about the money market and you talk about short-term debt, 1 day to a year, you have lower risk, but you also have lower reward. So that's where you park your short-term cash that you're going to need in a short period of time. Capital markets is where you take a long-term view, where you have a long-term plan, and you're investing in companies' equity or in their debt instruments, which have longer duration and longer risk, because you're taking a bet on the long-term future of these companies and their ability to perform over time. For most people, buying a piece of America's top 500 businesses with the S&P 500 is usually the way to go, and a low cost index fund over time, and you add to it over time and you dollar cost average. So when the market is really high, you're buying less shares. When the market's really low, you're buying more shares, which is counterintuitive, but that's what you want to do over time. But I think if you develop some skill around capital markets, particularly I'm an equity focused manager, you can really find bargains from time to time because the capital markets tend to be manic depressive. If you owned a piece of farmland, you wouldn't check the price of that farmland every single day. You'd have a general sense it produces this much yield every single year. I'm going to make that more or less, barring some crazy weather. You wouldn't go to check the quote. You wouldn't ask your neighbors, how much will you pay me for my land today? How much will you pay me for my land in a month? And that's what people do about the greatest businesses in the world. It's amazing to me. I'll give you one recent example, Zen. Disney. Everyone knows Disney, the greatest parks franchise in the entire world. Disney's trading somewhere down 50%, 55% off of its recent highs. This is Disney. This is not some speculative penny stock or some new crypto coin. This is one of the greatest businesses in the world. Their parks business was up 36% year on year, and the stock traded down on earnings. Why did it trade down? Well, they added 12.1 million subscriptions to Disney Plus, but their costs in the streaming side of the business were double what they expected. And the CEOs are going to have to bring those costs down, which they started doing. But in the capital markets, you take a long-term view and you ask yourself some common sense questions. Are more people going to be viewing Disney movies, Disney streaming? They've got Avatar coming up in December. Are more people going to go to the parks around the world as the parks open in China, for instance? When you look 2, 3, 4 years out, will it be a bigger business or a smaller business? What do you think, Zen?
Yeah, very interesting. I mean, at the end of the day, what you're really saying is that the capital market really does help to create stability by allowing companies to raise capital, which can also be used for to fund expansion and create jobs. And I think right now where we're headed, it's you have to, and it's my next question to Kyle, and it's one of the questions down the interview. But being very selective and choosy is, I think, is something that's trending very, very well right now with most people who are investing. But Kyle, when comparing the money market versus the capital market, there are several things that separate one from the other, but risk, and that's a big thing for everyone. Risk is an important consideration when deciding the best place to park your money. And since the money market tends to be shorter term in nature, what we've been covering, the risk associated with the financial instruments traded there is usually lower. But the capital market, on the other hand, may entail these higher risks to investors. It's the domain of stocks and bonds and other long-term securities. Kyle, how can an investor benefit from participating in the capital market currently in this economy? And what advice do you have when investing long term?
Well, Zen, here at Revere Securities, one of the most important things that we evaluate is we have to know our client. And every client can be a little bit different. Some clients that may be later in life, they're not willing to take on a lot of risk. And some people that are younger should have a longer term time horizon in their investments. But when we're looking at the capital markets, is there ever a perfect time to invest? Do they ring a bell at the top or bottom? Like Thomas was saying before, no, you want a dollar cost average. And if you dollar cost average into the 500 greatest companies in the world with these low cost ETFs, that's a great way for your core portfolio. And depending on your own personal risk tolerance, you can go ahead and satellite that portfolio with different ideas that maybe you'll add more beta or more volatility, but also could add more return down the road. Or it could be just a sector that you personally like. Maybe you like travel and leisure. Maybe you like anything to do with the space and what's going on there with satellites, with Elon Musk and what he's doing with Starlink. I don't know. But I do think your core portfolio should be dollar cost average over the long term. Because if you look at the history of, I'll just use the Dow, even though the S&P is a better indicator of the overall markets. In the year 1900, the Dow was 91. In the year 2000, it was over 10,000. And I'm sure I think we had 2 world wars, a Great Depression, a few famines, and a Cold War, and it still did pretty well over that 100-year period. So I think it's really important to keep time horizon in perspective whenever you're making your investments.
Very important. True. Very, very wise words. Time is extremely important to consider. Now, Thomas, let's shift back to something that you specialize in. Let's chat balancing acts. As the Fed walks the line between curbing inflation and averting recession, anxious investors are seeking to balance the two risks. Amid the uncertainty, stock selection matters more. In Q4, we've seen heightened volatility as inflation seeks a landing spot. a continued case for value as the economic cycle evolves, and interestingly enough, attractive opportunity in select growth stocks. Do you believe the answer is to own both growth and value stocks? And if so, why? And what is your overall market outlook for Q4?
Yeah, so Zen, that's a great question. Growth and value are tied at the hip. People try to quantify when you think of value, you think of energy, you think of banks, but you can also think in terms of people also put the FANG stocks, Meta, Amazon, Apple, Microsoft. They put them exclusively in the growth category, and some of these stocks have now come down to prices where they're trading at value multiples. So to call Apple or Meta a long duration asset is no longer the case. Long duration assets, you think of businesses that are promising a lot of earnings at some point in the future. And we saw the type of companies that were promising big growth but earning very little. They got absolutely destroyed in the rising rate environment over the last 12 months. But some of these tech companies that do generate a lot of cash, and they generate it currently, I wouldn't classify as long duration. And I do think that as we look forward into 2024, we may start to find a bid for some of these higher quality companies like the Amazons of the world. Meta would be much more risky because you're making a bet on the jockey, which in this case is Mark Zuckerberg. But that stock is down some 70-something% at this point. So there is value to be had in what were traditionally thought of as growth stocks. I think some of the value areas that people have been chasing, two of the areas that we were buying very, very aggressively during the pandemic crisis in 2020 were banks and energy. We've been laying off a lot of energy earlier this year, and of late, we find people are clamoring for it. We do agree that there's an underinvestment in the sector, but we also think that a lot of that is now priced in at these levels, and we want to start to skate to where the puck is going. One of the biggest ideas that we think will make sense, seeing the PPI numbers, the producer price index numbers come in lower than anticipated this morning, and the CPI numbers, consumer price inflation numbers coming in lower than expected last week. What you're seeing are two very important things then. Number one, bonds are getting bid, which means yields are coming down a little bit. And number two, the dollar is finally starting to weaken a little bit. What does that mean in terms of where you can benefit? A weak dollar generally is going to bode well for some of these value area techs that have been left for dead, as well as an area that's been absolutely decimated over the last 12 months, which is emerging markets. When the dollar goes down, a great place to have some allocation of capital, and we deal with very ultra high net worth and small institutions, would be in emerging markets. And you can get that exposure through an ETF. But I think as the dollar starts to weaken, as these inflation prints moderate, there's going to be a tremendous opportunity as you look over the next 1 to 3 years plus.
Interesting. Very interesting. Which this is a great segue because, Kyle, we have about 2 minutes left, but businesses, whether priced as value or growth, will weather this chapter in history with varying degrees of success. That's my opinion. This reinforces the need for selectivity and further argues for a focus on companies with quality characteristics. I know that's so important to you, particularly strong balance sheets and healthy free cash flow to offer a buffer in the case of a slowdown or profit squeeze. How choosy are you? Is this the time to be hyper selective when investing?
First, I want to say I agree with everything that Thomas just said. It's very important to pay attention to interest rates. If you look at the CPI and PPI, it looks like we're getting to a place we're going to stabilize on the rate environment. Now, if that happens, it is important to be tactical. And whether it's your risk tolerance, the emerging markets do make a little bit of sense. If the dollar weakens, it'll help multinational corporations. It'll help these technology companies, just like he mentioned. But I do think in a time like this, especially when you just went from zero to where we want, to be tactical when we know we're getting to a point where things are going to level off, that's how you can really add alpha and generate returns for your clients above and beyond just buying the S&P 500. That's like I said before, the S&P 500 is a great core, but being tactical around that core is how you add value, how you add alpha. And I think there are a lot of opportunities right now. And if you look at 3-4 weeks ago, the NASDAQ was coming to an end, all technology's over. The NASDAQ has substantially rallied over the last 3 to 4 weeks, and you may see that come into year end. especially if you get any more of this information, or if you get a little bit out of Chairman Powell saying, well, I like these CPI numbers, I like these PPI numbers, maybe we're going to put the brakes on for a little bit and see what happens. So opportunity is always out there, but being tactical, I think, is very important.
Wow. We are out of time. I just wanted to thank both of you for coming on. Thomas, thank you for simplifying it. Kyle, always a pleasure having you on. You guys are my experts at hand. And of course, we love having you on here on WOR.
Thanks for having me, Zen.
Thanks, Zen.
Guys, you definitely have to check out Kyle Wool and Thomas Hayes. That was our business and buzz segment brought to you by Revere Securities. Now, the money market and capital market play an important role in the larger financial market. Without them, businesses would not be able to get the short and long-term funding they need. There are a lot of reasons why people do not invest their money. A lack of understanding about the difference between money market and capital market investments can be one of them. Once you understand that the money market typically involves short-term, low-risk debt instruments, while the capital market likely revolves around long-term ones with higher risk and reward, you will be on your way to better knowing how the global financial market works. When it comes to the goal of making your money grow, definitely consider Revere Securities and definitely check out our expert Thomas Hayes at hedgefundtips.com. You're listening to A Moment of Zen right here on 710 WOR, the voice of New York, iHeartRadio. We'll be right back after this.